Hi again, everybody. In this video, we will post 10 business transactions to a spreadsheet for Craven's consulting service. You will get the most benefit from this video lecture if you download and print the worksheets published for this lecture, or you can download the Excel worksheets and work in Excel. You need to do this so you can follow along with the video and practice posting business transactions. To download the worksheets, click on the link directly above the video on this Canvas page. One of the primary purposes of this practice session is to understand how business transactions affect the accounts in the accounting equation. So let's take a close look at the spreadsheet and see if you can spot the accounting equation. Assets equals liabilities plus owner's equity minus dividends plus revenue minus expenses. There is a separate column for each of the asset accounts: cash, accounts receivable, and office furniture. The only liability account is accounts payable, and it has its own column. There are separate columns for each of the two equity accounts, common stock and retained earnings. Separate columns are provided for dividends and consulting revenue, but there is only one column for expenses, even though we'll be working with several expense accounts. Rather than make this spreadsheet even wider than it already is, all expense amounts will be shown in the expense column, and the titles of the expense accounts will be written in the description column. We will be recording business transactions for the month of January. The account balances at the beginning of the month were as follows. So on January 1st, the account balances were cash $38,800, accounts receivable $12,000, office furniture $24,000, accounts payable $10,000, common stock $50,000, and retained earnings $14,800. The two equity accounts combined together equals $64,800. So at January 1st, the owner's equity of the company total is $64,800. Let's make sure our books are in balance at the beginning of the month before we begin to post our January transactions. Do assets equals liabilities plus owner's equity? Let's check it out. The total of the assets is $74,800. $38,800 plus $12,000 plus $24,000 equals $74,800. And on the other side of the equation, $10,000 of accounts payable plus a total of $64,800 in owner's equity also equals $74,800. So assets do equal liabilities plus equity, and the books are in balance on January 1st before we begin recording our January transactions. Before we begin this exercise, we need to talk about double entry accounting. Double entry accounting means that every business transaction will affect at least two accounts. There could be more than two accounts involved, but at least two accounts will always be affected by each business transaction. I think you'll see what this means as we progress through the exercise. If you page down on this spreadsheet, you will find the 10 business transactions and a chart of accounts. Let's first read and analyze transaction number 1. wrote a check for $1,500 to pay for January's rent. What accounts are involved? Remember, there are always at least two. Well, we spent $1,500 in cash, so the cash account is involved, and the balance in cash will decrease because we spent the money. And looking at our chart of accounts for expenses, it looks like we can use the rent expense account title because we incurred rent expense for the month of January. Before this business transaction, we had no balance on the books for rent expense. Now we get to increase the balance in the books for rent expense. So let's post this transaction to our spreadsheet. We have a $1,500 decrease to cash. Notice that I wrote the decrease as a negative number in brackets. And we have a $1,500 increase to rent expense. If we're going to increase an account balance, write the number as a positive number. Let's do the next transaction. Paid $1,700 in cash for new office chairs. What accounts are involved, and does their balance increase or decrease? Well, cash is involved because we spent the cash, so we're going to decrease cash for $1,700. The purchase of new office chairs should not be recorded as an expense. Those chairs will be used by the company for a number of years to come, so they fit the definition of an asset. Let's see if we can find an appropriate asset account title. Well, it looks to me that office furniture is perfect. So let's record a $1,700 decrease to cash and a $1,700 increase to office furniture. Transaction 3. Received $11,200 from credit clients. So what accounts are involved, and do their balances increase or decrease? Well, cash is involved because we received cash from customers, so we're going to increase cash by $11,200. Credit clients means customers who owe us money. The amount of money receivable from a customer is recorded in accounts receivable. Before this business transaction, our customers owed us $12,000. Now we are receiving payment for part of that amount. Before this business transaction, our customers owed us $12,000. Now they've paid us $11,200. That should leave us an $800 balance in accounts receivable after the payment. Let's see if that's the way it works. One moment. Increase cash by $11,200. Decrease accounts receivable by $11,200. And yes, that does leave an $800 balance in accounts receivable after this transaction. Transaction number 4. We performed $10,680 services on credit. What two accounts are involved, and did their balance increase or decrease? When we perform services on credit, it means that we have earned the income, but we will receive payment from our customer later. So we're going to increase consulting revenue and increase accounts receivable. Increase accounts receivable by $10,680. Increase consulting revenue by $10,680. Transaction number 5. Sent a check for $6,500 in partial payment of the amount due to creditors. What two accounts are involved, and did their balance increase or decrease? We sent a check. That means we spent the money. So cash decreased by $6,500. We made a payment on the balance due to our creditors. Well, before this business transaction, we owed our creditors $10,000. Now we're paying part of that bill. So we're going to decrease accounts payable by $6,500. Decrease cash $6,500. Decrease accounts payable $6,500. Why don't you pause this video and take a few minutes to record transactions 6 through 10. When you're finished, start the video again to check your work. Transaction number 6, paid $9,700 for salaries, $9,700 decrease to cash, and a $9,700 increase to expense, specifically salaries expense. Transaction 7, paid $1,120 for the electric bill, decrease to cash $1,120, increase to utilities expense $1,120. Transaction 8, paid $2,350 for auto repairs. Decrease cash $2,350, increase repairs expense $2,350. Transaction 9, perform $12,500 services on account. Performing services on account is the same thing as performing services on credit. Services are complete, but we haven't been paid for the work yet. Instead, we will receive payment from our customers later. Increase accounts receivable by $12,500 and increase consulting revenue $12,500. Transaction 10, paid dividends in the amount of $5,500. Decrease cash $5,500 and increase dividends $5,500. Did you get them all recorded correctly? If not, please pause this video and take a few minutes to fix your spreadsheet. Okay, now that we have recorded the increases and/or decreases in account balances as a result of the business transactions for the month of January, we need to find the new balance in each account and see if our books are still in balance. Finding the new balance is very easy. Just add up the columns. Start with the beginning balance and add increases and subtract decreases and put the new balance here. The new balances at the end of the month for each of the accounts are as follows. Cash $21,630, accounts receivable $23,980, office furniture $25,700, accounts payable $3,500. Common stock and retained earnings did not change. Their balances remained at $50,000 for common stock and $14,800 for retained earnings. Dividends $5,500, consulting revenue $23,180, and expenses in total $14,670. Now let's check to see if our books are still in balance. Do assets equal liabilities plus owner's equity minus dividends plus revenue minus expenses? Remember that owner's equity is the combined balance of common stock and retained earnings. Please pause your video and see if you can figure this out. Once you think you've got it, start the video again to check your answer. Well, I get $71,310 total of assets. That's $21,630 plus $23,980 plus $25,700. I also get $71,310 total on the other side of the equation. That's $3,500 plus $50,000 plus $14,800 minus $5,500 plus $23,180 minus $14,670. So both sides of the equation equal the same dollar amount, and our books are in balance. Well, that's all for this lecture. In the next video, we will use this spreadsheet to talk about how we're going to prepare financial statements for Craven's Consulting Service. See you next time.